Hi friends, welcome to Adda 24/7. We are in the BFM most important questions and case study series for your November-December exams. In fact, this series is for all the subjects ABM, BFM, BRBL, and ABFM. That's why I'm saying subscribe to the channel first. Officers Adda 24/7 English channel. Also, share this channel, like this. In fact, this video also. Watch it till the end, like this video, share it with your friends, share it on all your social media platforms so that others can also benefit. Share. Giving is basically enriching the knowledge, isn't it? Let's move on. First question. Which of the following, means which of these are not the products of foreign exchange market? No, not the products of foreign exchange market. Okay, so swaps, spot rates, commodities, and forward rates. So you want those which are not the products of this, products. So swaps, do we do in foreign exchange? Yes, we do. What is a swap? I'll show you. We are having a separate question on swap. Spot rates, do we do in forex? Yes, we do. Spot rates, right? Commodities, do we do in foreign exchange? Commodities is separate. Okay, commodities means it's related to gold or even this oil. Okay, so foreign exchange market, this is at least we are talking of CAIIB. Yeah? Somebody can argue that dollar is also a commodity. So that argument can definitely go. In that way, anything is a commodity. So the point of concern over here is related to your only CAIIB for forex. So spot rates, you have this. Commodities are separate, and forward rates, we have forward rates for our forex also. So not the products is, answer is this. Okay, commodities C. Next, which of the following are correct regarding the loan review officers? Now this loan review officers means what? This is similar to the credit audit. Okay, so this is from your module C. The module C, yeah. Okay, and this question is common in your ABM also. Kindly note, ABM also, BFM also. He or she can be a fresher without any expert knowledge on the credit appraisal. So can be a fresher without any expert knowledge. So loan review officer is a experienced person. Kindly note. It's basically we are talking of credit audit from ABM. Okay. The same question is there in your BFM also, module C or D it can come. D only mainly, D. He should be well versed, he or she, it's not only he or she should be well versed with the relevant laws, regulations. So that is true. So this is also true. Independence of loan review officer should be ensured. That is also true. Okay. So answer is B and C. Which of the following off balance sheet exposures items come under the low risk categories? So low risk, which of them are low risk? Swaps, LCs, money guarantees and indemnities. So which of them come under low risk categories? Think of it. Many of us think, many of you amongst you might be thinking now about, I think so, LCs, letter of credit. Okay, many of you might be thinking that LCs, but the answer is not LCs. Okay, let me check what is the answer you are giving. Let me see. The answer is, it is swaps. Okay, the answer is swaps. Now what is a swap? Okay, what is a swap? Let's see. Let me first mark the answer. Swaps. Okay, so what is a swap? In swap, kindly remember there are two legs. Firstly, one is fixed, second is floating. See, always remember the basics about swaps. Let it be currency swap, let it be interest rate swap, let it be any swap, financial swap. There are two legs. One is fixed, other is floating. Okay. Second point about swap is it is always exchanged principal plus interest. Both are exchanged. P plus I. Only there is one swap in which only interest is exchanged. Only one swap, interest is exchanged. Otherwise, it is principal plus interest, both. Third is the flow of exchange, means streams. Various streams of payments are exchanged. Streams means lump sum versus EMI. Or there can be other also. Dollar pay stream versus rupee stream. It can be anything. Dollar stream versus rupee stream. Or lump sum versus EMI. Or it can be, for example, RD. What is RD? RD is basically again the flow of streams. So kindly understand, swap is the answer for low risk category. Why? Because here both the things are almost hedged. Now let's say, what about this LC, money guarantee and indemnities? Those are high risk. Why? Because there is a chance of credit default over there. Credit default in all the three. Swaps have very less credit default. Why? Because both the legs fall under the rules of your international swap agreements or international swap rules. There we first only take the credit risk into action, into our calculations. Okay, and we only swap those currencies which have low credit risk. Means nobody amongst you will be swapping Brunei currency because there is no liquidity to it. Nobody will be swapping some South African Ethiopian currency. No, there is no liquidity to it. We generally swap those currencies which have high liquidity. Generally dollar, pounds, Australian dollar, rupee. Okay, these are Pakistan rupee. Will you swap? Nobody, isn't it? But what about, because here we are eliminating the credit risk. That is very important. Market risk is obviously there. See here, anywhere you go, you'll find the market risk. That is obviously there. But credit risk, you can eliminate. And that is the main concern. Now, what about LCs and money guarantees and all this indemnity? There is a major credit risk over there. Credit risk means what? It is here. All these three, if you check this, these are between two parties only. Buyer and seller. You and the customer. There are only two parties. So there is always a risk of credit. Means if that customer tomorrow defaults, then what? In any of these, LC, guarantee or indemnities, in any of these, if the customer defaults tomorrow, then what will you do? The same default can't happen in swaps because we have already checked the liquidity part or the credit risk part. LCs, many a times what happens, you give the LC. What is the LC? You give the LC on behalf of your customer to some XYZ client, okay, some other country. And when the LC comes for payment, your client doesn't pay you, but you have to pay it compulsorily. So there is a chance of NPA, high risk. Same thing about guarantees, same thing. Indemnities, again the same thing. Same. What is an indemnity? Indemnity means when you give the indemnity. This is concerning the indemnity from your side. So you give the indemnity on. So that's why these are high risk instruments. Which of the following activities are included in treasury management? Included. You want included. So which of them are included? Fund management, risk management, forex operations, profit maximization in money market. So treasury management, which of them are included? Fund, risk, forex, profit maximization. What do you think? Is it fund, is it risk, is it forex, or is it profit, or both? All of them. 1, 2, 3, 4, or is it 1, 2, 3, or 2, 3, 4, or 1, 3, 4? What is important? See, nowadays we are talking of integrated treasury. Integrated treasury means what? The treasury links your local banking business to the international markets. So in integrated treasury system, this is particularly important. Fund, risk, forex and profit maximization, all of them. So the answer is all of them, D, 1, 2, 3, 4. Okay. Kindly note fund management, risk management and forex. Profit maximization, you understand, means I have to increase my profit. That's a simple logic. In the money market, remember, in the money market, the major advantage is you don't have a credit risk, mainly credit risk, okay? Because we generally deal in those bonds which are triple A plus. Now, fund management, risk management, and forex. Here, always, what is this fund management? Basically, whenever you are in banking or any business, you will deal in only three basically markets: equity, debt, and money. Money means totally liquid market. Similarly, in mutual funds also you have equity funds, debt funds, and liquid funds. Same logic is applied over here. So you need to optimize this equity, debt. Optimize means what? Optimize means basically you need to see to it that the equity investments and the debt investments are optimal, not maximum. Otherwise, you'll definitely face a default risk. Means default in the sense market risk, not default risk. Because in equity and bonds, you can face the market risk. Money market, if you maximize the investment, your risk will be lower. Risk will be lower, but your returns will also be lower. Okay, that is the basic problem. Got it? So we always try to optimize all the three. We try to balance between them. Okay. Now before going ahead, everyone, I would suggest subscribe to the channel Officers Adda 24/7 English channel. English and Hindi both. Okay. Click on the bell icon. Share it with your friends. You get all the free YT series here. Right now, what are you watching? You're watching it over there only. You get the latest updates. Join the crash course. Just now it is started. Very, 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 very important. Okay. All the important topics, theory, questions, I am covering this. So join it immediately. Join this Mahapack. In Mahapack, you are getting multiple batches. I'll show you at the end. 15 plus batches per subject. I'll show you at the end how to join this. Okay. Let's move on with the next question. Under which method of value at risk calculation, VR is calculated using a sample of randomly generated price scenarios? So under which method is this done? Now look at the following options also. Okay. Yeah. So look at the following options also. Correlation method, historical simulation method, Monte Carlo simulation method, and backtesting. So which is the method used? VR is calculated using a sample of randomly generated price scenarios. Under which method? So randomly generated price scenarios. Correlation, historical simulation, Monte Carlo, or backtesting. Think over it, everyone. Under which method is this done? So the answer is, think over it. First here, okay, let me clarify a few methods over here. Correlation method. Correlation method, you are having it in your ABM mainly. Correlation and regression. Here two elements are compared. Always remember, here only two elements are compared. Any two. There can be two scenarios, two situations, anything. But two elements are compared. But in practical life, we have many elements coming up at the same time. Okay, so correlation is that. Historical simulation means what? It is based on the history. So it is a similar sort of backtesting. Means here we consider the historical data for last 10 years or 20 years or 30 years depending on the bank. So we consider the historical data and the bank's risk department. And then based on that we can create the scenarios. Okay. Now there is a problem in this. Means whatever has happened in earlier life, similar thing will happen. That's what is assumed. But there is a problem in this. For example, I'll give you in 2019. If I'd have asked you in November 2019, everyone pay attention. Will the world come to a halt? in next few months, all of you would have called anyone who is calling this that the world will come to a halt. You would have called that person a lunatic, mad, right? But what happened? It did come to a halt. 2020 and 21, completely the world, entire world was at the pause, right? So backtesting is a problem because what has not happened earlier may happen later. So that is historical simulation. Monte Carlo means what? Monte Carlo simulation is a simulation of generated scenarios. So now this is fitting this question. Okay. So Monte Carlo simulation is the right answer. C is the right answer. Okay. Now Monte Carlo simulation, let me give you some details of Monte Carlo simulation. Okay. Monte Carlo simulation method, it calculates a change in the value of the portfolio using a sample of randomly generated scenarios. Okay, randomly generated scenarios by making assumptions about the market structures. Market structure means whatever will be the future of the market. Correlation between the risk factors and the volatility. So it uses correlation also. Okay, risk factor and the volatility. It is opposite to that of the historical simulation, right? Opposite why? Because in historical, what do we do? What has happened earlier will happen in future. But in Monte Carlo, randomly generated. What has not happened earlier may happen in future. Okay. As in this, it uses views and experience of as opposed to the naive approach or the used approach. Okay. Naive means it's the same old method used. Okay. The simulation method is best for all the three methods, right? So that's why here, future you don't know, but you can assume about the future through some learned man, right? So that is the first answer. Which of the following are eligible for financial collateral? Financial, okay? Which of them are eligible? This is a module B question. Mutual funds and equities, debt securities rated by chosen credit rating agency, attracting 100%. This is 100% of or lesser risk weight, rated at least BBB minus when issued by the public sector. Kisan Vikas Patra, life insurance policies, gold. So which of them are eligible as a financial collateral over here? What can you, suppose if I come to you tomorrow, okay, in a bank for loan, I'll ask you, sir, I want the loan, sir, madam, whatever, and these are my collaterals. Will you accept them? Mutual fund, equities. Debt securities means bonds issued by some credit rating agency, at least BBB minus. So will you accept them? Or I am having Kisan Vikas Patra, life insurance policies, right? What do we call this loan? This is known as loan against securities. Loan, LAS we call it, loan against securities. Okay. All the three, see here, all the three are commonly called as loan against securities. Okay, because securities means what? These are all paper securities. Okay, so now what is this called as? Which of them are eligible? All of them are eligible. Mutual fund equities, yes. Debt securities, yes. Kisan Vikas Patra, LIC, yes. Okay. Generally for mutual fund and equities, we give loan up to 60%. Generally, 60%. Okay. For this debt bonds, again we give up to, depending on the rating, we give up to around 60 to 70%. Okay, 60 to 70%. Some banks may give up to 80% also, but general rule is 60 to 70. LIC policies, this LIC policies, Kisan, these are sure shot, these financial collaterals. So against this, we give the loan of around, here against LIC I am telling you specifically, some banks give around 80% of the sum assured. 80%. Depending on bank to bank, it's there. Whatever is that, what? The amount, okay? So 80% of, not sum assured actually. I said sum assured of what? No, it's not sum assured. 80% of your surrender value. Surrender. Sum assured is totally different. Surrender value, okay? So what is the answer over here? All the three. D, 1, 2 and 3. Got it? Next one. Which of the following is a correct definition of Macaulay duration. Macaulay. Remember, there are two durations. What are the two durations? Who can give me? Type in the comment section. What are the two durations? What are those? Type in the comment section. Which are the two durations? Yes. Which are the two durations? Comment section, everyone. Let me see. Yes. Two durations are, one is Macaulay, second is modified. Macaulay. And second is modified. Okay, modified. Got it? So what is the definition of Macaulay and modified? Let's see. It is defined as the weighted average to cash flow of a bond where the weights are nothing but the present value of the cash flow themselves. It is a net sum of cash flows and cash inflows and outflows. It is a ratio between the fixed income portfolio's price sensitivity to interest rates changes. It calculates the investment rate of return and annual growth rate. So what is the correct answer over here? Definition of Macaulay. Let me see. Yes. Is it this sum of cash inflows and outflows? Is this cash inflow and cash outflow net sum? No, that is wrong. Okay. Ratio, it's not a ratio between fixed price, what fixed income portfolio's price to interest rate changes. No, this is totally out because this is not related to Macaulay. Investment rate of return and annual growth rate. No, it does not calculate the growth rate at all. It never calculates the growth rate. It is basically this weighted average. Here, firstly understand what is Macaulay. Macaulay means that period in the bond, that period in the life of the bond, okay, in life of the bond, where where the interest rate risk is zeroized. Rate risk is nullified or zeroized. Okay, nullified. Okay, that is known as this Macaulay duration. Got it? So nullified means what? The other words for saying this is this. It is defined as the weighted average to cash flows of a bond where the weights are nothing but the present value of the cash flow themselves. Okay, present value. See here, further I can give you this. It is expressed in years. Always remember, Macaulay is expressed in years and modified is expressed in percentage. The duration of the fixed income security is always shorter than its term to maturity. So this Macaulay duration will always be less than the life. Only in case of zero coupon bonds it's same, except in case of zero coupon bonds where it is same. Okay. Modified duration measures, see here, now I am talking of modified. Modified duration measures the price change in the bond given as a percentage of change in this interest rates. So that is for modified. Got it? So Macaulay and modified. Got the clarity? So A is the answer. Okay. Now as I told you before going, I will be showing you how to join the Adda 24/7 classes. Let's see. See here, go to Adda 24/7. I'll always suggest you to go through the app. In the app you get 1% extra using the coin systems. Okay. So go to Adda 24/7. Click on JAIIB and CAIIB. Let me show you. Say this. Go to Adda 24/7. Over here now click on JAIIB and CAIIB. Say this. Click on CAIIB November. Okay. Look at this crash course. Click on this crash course. Right now check the discounts. Ebooks, test series, online live classes, expert faculties, interactive classes, recorded videos, limited size batches, everything you are getting. And now click on buy now. Put the code Y432. Y432. Click on apply. To get a 79% discount plus 1% extra using the coin systems. So 80% discount you are getting. So join it ASAP, and this crash course is a must for you. Is a must. Why? Because exams are just few days and full portion is covered in this. Join ASAP. You can join this Mahapack also. In Mahapack you are getting double validity right now. 15 plus batches plus double validity plus 80% discount. All the three. Ebooks, test series, these are available over here also. In Mahapack you get the electives also. Very important. Okay. So join ASAP and use the code Y432 for maximum discount. Y4